Oil prices have been rallying strongly in recent weeks as a global energy crisis driven by a shortage of natural gas has seen everything from natural gas to coal and oil rallying very, very strongly. Now, the biggest gains themselves have actually come in the natural gas market. This is where the shortage has actually occurred. Now, the shortage itself has actually been driven by a number of different factors, whether that be outages in Norway or restocking and refueling in Russia and other countries, a surge in demand from Asia, a surge in demand really globally since the economic reopening and the activity that's been generated on the back of that, which means that many countries have not refilled their stocks that were used up during a cold winter period last year. So stocks would normally be high now, and it's these lower stocks at a time when we are seeing an actual shortage that's driving the panic moves that we are already now starting to see in the markets. And like I say, natural gas is where we've seen the biggest rises, but we are seeing strong price movements in everything from nat gas to coal to oil prices and carbon credits as well. So it's really interesting to see what kind of movements we are now seeing in these oil markets. An oil market which was already relatively tight ahead of this. We know, of course, that OPEC has been gradually turning supply back on. Now, there was that record cut at the start of the pandemic, and a few months ago, back in July, the group of OPEC plus some additional producers, including Russia, agreed to increase production again by 400,000 barrels per day each month, bringing their output back to pre-pandemic levels by the end of next year. Now, the meeting earlier this week, there was a small but growing expectation that the group would actually decide to ramp that up, maybe to 600,000 barrels a day, maybe even 800,000 barrels a day per month in the short term, to alleviate some of those shortages that we are seeing in other markets as oil and coal demand starts to grow in the absence of natural gas. The group opted against it, and the rationale they gave for it was that they expect demand to potentially soften going into the coming months because of surges that we see in COVID cases during the winter period in the Northern Hemisphere and the impact that that's going to have on activity and demand. This is also a group as well that's just dealt with for a long time now with extremely low prices. So I think state budgets are probably looking at this and seeing the higher prices that we're seeing and seeing them not as being potentially recessionary, but as being more than offsetting, or at least partially offsetting the losses that they have made over the course of at least the last 18 months, but at times even prior to that as well. So we're not going to expect anything from OPEC in the near term, although month by month, if we do see demand remain strong and prices move towards $90, $100 a barrel, then we could start to see them stepping in. Now, oil prices themselves, like I say, have been rallying. WTI, as you can see on the chart here, reaching $80 a barrel. Brent crude is already now trading above $80 a barrel. Now, we've run into some resistance around that $80 mark. I think this is a technical pullback in many ways, given where the rotation actually happened. But it also occurred around the time yesterday that Vladimir Putin was speaking. Now, the Russian president there providing some comfort for the markets, suggesting that Russia has supplies that can alleviate the issues of this energy crisis, and potentially a little nod there to the approval of the Nord Stream 2 pipeline, which effectively routes around the Ukraine. Russia claiming that it reduces CO2 and also reduces prices and makes it more profitable to pump these the extra demand that's being that we're seeing right now in the markets. So a little nod there to the regulators to try and get this over the line sooner rather than later, despite the heightened political pressure from the US, but also from the Ukraine itself and others, because it effectively leaves the EU a little bit more vulnerable, effectively, to Russian natural gas. And this has been a political debate that's been taking place for many years now. It was the source of the sanctions that came from the US on Russia during the Trump administration. So these comments that we had from Putin yesterday came at an opportune moment for these markets. The fact that WTI was trading at $80 a barrel, we saw it pull back from these levels, and I think we saw some profit taking kicking in on the back of these too. We also saw some inventory numbers, which also gave an extra nudge to the downside as well for many of these oil prices. But the question becomes now, which way are we heading next? Where are the key support levels? Well, during such a strong uptrend at a time when we are seeing a relatively tight oil market when we are seeing inventories being gradually worn down, and when we're still waiting to see whether Russia is going to provide that extra additional shortfall that we're seeing around Europe in terms of natural gas, which will keep energy prices elevated. It's hard to expect we're going to see too significant a fall. So in terms of the key levels to keep an eye out for me, I think we've got to be looking around that $72, $73 level where we see those previous areas of support and resistance. But $70 looks really interesting as well, because that would mark a little bit more than a 10% pullback, which under normal circumstances you would think would be pretty significant. And in many ways, I'll be surprised if we do pull back that far, but we've got to remember that the gains have also been extremely significant as well. A pullback towards that $70 level would also be a 50% retracement of those August lows to yesterday's high. So I think that will be a really interesting area. And as you can see, going back on the chart, that 55 89-day simple moving average band has proven to be quite an important level of support, barring that period at late August when we pull back to the 200 233-day simple moving average band before rotating higher once more. So if we are going to see a pullback and a corrective move, a significant correction of that, then I think 70 is going to be a massive line in the sand. But like I say, if we get that far, because already we're seeing some support coming in around that $75 level, and like I say, I think medium term right now, it's hard to not think that we could potentially see some more gains here, especially if OPEC and their allies are going to remain on the sidelines and continue to watch how this situation unfolds. But ultimately, if we do see the natural gas taps being turned on from Russia and we start to see fears of an energy crisis becoming something less severe, then that could potentially take some heat out of the market. So I think these markets are going to remain very volatile for the weeks to come. And as we move into the winter, especially if we see cold weather return and we see it colder weather than we were expecting, which means countries using more fuel in order to heat their homes, etc., that I think we could start to see some really interesting moves. And if oil prices start to move towards $90, $100 a barrel, we can expect a lot more attention on those OPEC meetings, which take place every month at this point as they monitor the global demand and supply situation in the energy markets. Remember, Saudi Aramco this week also said that the surge in demand for oil on the back of the energy crisis has led to an increase in demand of 500,000 barrels a day at this point. That's quite a significant jump. So if we do see no shortage in demand in the next few months, I'm sure we can expect the group to become a lot more active going into year end.